I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to, growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case again is the airline business. The airline business has been a growth business ever since that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock, who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money, we're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
In this video, we'll be talking about 3 ETFs that I think are very long-term holds, which could also give you a good growth potential. Welcome to the Nick Finance Clips channel. On this channel, I basically pour through tons of ETFs, filter out the best, and also distill those into the best of the best and bring it to you guys on this channel. And in exchange for that, I ask that you hit the like button and subscribe to the channel for more content like this if you don't mind. And with that said, and without further ado, let's get into the 3 ETFs on this list. The first is the MGK, that's the Vanguard Mega Cap Growth ETF. You know very well on this channel, I'm a big fan of Vanguard, but this comes in as number 3 for several reasons. Check out the 5-year growth performance of this ETF at 154%, which is quite decent. The ETF offers a yield of 0.47% and has assets of $12.11 billion under management. The expense ratio stands at 0.07%, which is typical of Vanguard having low cost ETFs. Taking a deeper look at the dividend, you'll see a 5-year negative growth rate of minus 4.07%, which is what I typically don't like. Now, I always prefer the growth rate to at least be positive. And checking out the holding breakdown, it's not unexpected that the bulk of the holdings are in the tech sector, which is a very fast growing sector, with consumer cyclical and communication also coming out tops. Then you'll see names like Apple, Microsoft, Amazon, Tesla, Meta Platforms, Nvidia, and the likes in this ETF. So what gets me going for this particular ETF is the low expense ratio. However, because of the negative dividend growth over the past 5 years, this has come in as number 3. The second ETF on the list today is the Spyder Portfolio S&P 500 Growth ETF, which has seen a 5-year growth of 138%. The ETF has a decent yield of 0.68% and $13.82 billion under management. I can't take my eyes off the low expense ratio at 0.04%, which means I can keep basically the bulk of the returns to myself and not have to pay a bulk fee to managers. Drilling further into the dividend yield, you'll see a 1.825-year growth rate, which is something I like to see when I appraise ETFs. There just has to be that dividend growth rate for that ETF. And from a holding standpoint, again, technology comes out tops with consumer cyclical and communication also having large spots in this ETF, which is somewhat similar to the Vanguard Mega Cap ETF we discussed earlier. So by and large, I like this ETF because it gives me that S&P 500 feel, which is one thing I always look closely at. It has a low expense ratio and the dividend yield is both high relative to others and also growing as well. The number 1 on my list is the Invesco Triple Q Etf, that's ticker QQQ. This ETF has a huge asset under management of $188.53 billion with a 0.47% dividend yield and a 0.2% expense ratio. Now, a 0.2% expense ratio is definitely high compared to Vanguard and the Spyder. However, because of other factors, you'll see why this came in as my number 1. The holdings in this ETF, again, being a growth ETF, focuses on technology, communications, and consumer cycle again, with the household names coming out like we already saw previously. So the QQQ comes in as number 1, and I would see this as an ETF that I can actually buy and hold for a very long time, probably forever. Now guys, let's do a comparison among these 3 ETFs and I'll show you exactly why I chose one above the other. Quick plug, don't forget to like the video and subscribe to the channel for more ETF content. My goal is to make this channel cover at least all the available ETFs on the market, with particular emphasis on the best of the best. So you might want to subscribe and just see this as an ETF haven. Now, lining them up side by side, you see that the MGK, which is the Vanguard ETF, has the smallest asset under management compared to the QQQ that has the biggest. This shows that more funds are invested in this ETF relative to the other 2. The 5-year growth performance also shows that the QQQ has the best growth over the last 5 years. The SPYG has a 0.68% dividend yield and has a 1.82% dividend growth rate over the last 5 years, which to me is superior to the MGK. However, when I check the QQQ, I see a 0.47% dividend yield with a 6.25 dividend growth, which is what I like to see. Talking about the fees, the SPYG is definitely the best at 0.04, with the QQQ having a 0.2% fee, which is relatively higher compared to the others. Now, all 3 ETFs are exposed to technology, communications, and consumer cyclical, which are the fastest growing sectors on the market. Bear in mind that they also pay dividends quarterly. So the reason the QQQ came as the best to me is the fact that I, to an extent, would like to bake some growth into my portfolio. So this is one ETF that allows me put in that growth factor whilst also enjoying the benefit of having an exchange traded fund that is well diversified across different sectors and different stocks. So one last point on this video, guys, before you go off is this. Let me know in the comment section which other ETFs you would like me to take a look at, and let me know which of these 3 sticks out as the best for you in your own personal opinion. Bear in mind that none of this is financial advice. I'm just sharing my personal opinions based on my ongoing research on ETFs in the US market. With that being said, thank you so much for stopping by and watching this video again, and don't forget to like and subscribe, and hopefully I'll see you all again in the very next video, which should come out shortly. Cheers.